Altria Group Inc., ticker symbol MO, is one of the largest producers and marketers of tobacco, cigarettes, and related products in the United States. Headquartered in Richmond, Virginia, the company's flagship brand, Marlboro, is the top-selling cigarette in the U.S. But Altria is more than just tobacco. Over the years, it has diversified its portfolio, expanding into smokeless tobacco, wine, and cannabis through investments in companies like Cronos Group. Did you know Altria started as Philip Morris & Co. in 1847, a small London-based tobacco shop? Fast forward to 2003, the company rebranded to Altria Group, signaling its intention to evolve beyond cigarettes. The name Altria is derived from the Latin word altus, meaning high or noble, reflecting its ambition to elevate its corporate image. Is Altria Group still a solid investment, or just a puff of smoke? Let's find out. In this video, we're diving deep into Altria Group's revenue journey from 2014 to 2023 to uncover the story behind the numbers. From steady growth periods to surprising dips, we'll analyze how major events, acquisitions, and divestitures shaped the company's financials. But it's not just about the numbers. We're answering the big question. Does Altria's revenue history make it a good investment today? Stick around to hear our verdict and get insights that could reshape how you think about investing in this tobacco giant. By the end, you'll know whether Altria has what it takes to make the cut in your portfolio, or if it's time to look elsewhere. Ready? Let's go. At the close of 2014, Altria Group's diversified portfolio included subsidiaries engaged in the production and sale of traditional cigarettes, smokeless tobacco products, cigars, pipe tobacco, and wine. Key players included Philip Morris US, focused on cigarettes; Middleton, specialized in cigars and pipe tobacco; UST, through subsidiaries like USSTC and Stay Michelle, covered smokeless tobacco and wine; Newmar, manufactured innovative tobacco products; PMCC managed a portfolio of finance assets, primarily leveraged leases. Altria also supported its operations through companies like Altria Group Distribution Company and Altria Client Services, which handled distribution, regulatory, and administrative tasks. Notably, the company held a significant 27% stake in SAB Miller, contributing to its revenue through dividends. Revenue and growth in 2014, $24.5 billion, a modest increase of approximately 0.2%, $56 million. Key factors influencing revenue in 2014. 1. Stable core business. The smokable product segment remained the primary revenue driver, particularly with strong sales of Marlboro. 2. Smokeless and innovative products. While smaller contributors, these segments supported incremental growth. 3. SAB Miller. Dividend income from SAB Miller bolstered overall revenue, though it wasn't a significant driver of year-over-year growth. 4. Wine segment contributed steadily, but didn't reflect major expansion. 5. Market conditions. Price increases and cost management efforts offset the slight decline in cigarette shipment volumes. By the end of 2015, Altria maintained its diversified portfolio, with operations spanning cigarettes, cigars, smokeless tobacco, wine, and innovative tobacco products. Key points include: Altria held a 27% stake in SAB Miller, earning dividends. A significant development occurred on November 11, 2015, when AB InBev announced a proposal to acquire SAB Miller in a cash and stock transaction. This move foreshadowed potential long-term financial impacts. Operational highlights. PM USA, UST, and Middleton remained the core drivers of the smokable and smokeless product segments. 2015 revenue, $25.4 billion. Growth, approximately 3.7%, $912 million. Key factors influencing revenue in 2015. 1. Smokable segment dominance. Marlboro's strong performance continued to anchor revenue, with price increases offsetting volume declines. 2. Smokeless and innovative products. Ongoing development of these categories contributed to incremental gains. 3. Wine business. Stay Michelle delivered steady results, maintaining its role in Altria's diversified strategy. 4. SAB Miller transaction. While the AB InBev deal did not directly affect 2015 revenue, it hinted at future changes in cash flow related to Altria's stake in SAB Miller. Recurring themes. Heavy reliance on the smokable product segment for revenue, consistent use of pricing strategies to manage cigarette volume declines, gradual revenue growth from smokeless and innovative products as consumer preferences evolve. In 2016, Altria Group reported revenue of $25.7 billion, showing a 1.2% increase from the prior year. During this time, Altria finalized its transition in the SAB Miller and AB InBev merger. By the end of the year, Altria held a 10.2% ownership in AB InBev after purchasing additional shares. Dividends from this stake were anticipated to enhance cash flows. Additionally, Altria prepared to expand its smokable products portfolio by acquiring Nat Sherman, a well-known premium cigarette and cigar brand. Early in 2017, the company's core segments, smokable products, smokeless products, and wine, continued to deliver consistent contributions to overall performance. Altria's strategic investments and acquisitions in 2016 demonstrated its commitment to enhancing shareholder value while diversifying its portfolio. In 2017, Altria Group reported revenue of $25.6 billion, slightly decreasing from $25.7 billion in 2016. By the end of 2017, Altria's wholly owned subsidiaries included PM USA, cigarettes, Middleton, cigars and pipe tobacco, Nat Sherman, premium cigarettes and cigars, acquired in early 2017, and UST, smokeless tobacco and wine. Additional operations were carried out through Newmark, innovative tobacco products, and PMCC, finance assets. Altria maintained its 10.2% ownership in AB InBev, stemming from the S.A. Miller-AB InBev merger, generating potential dividend income. This year, Altria showed a commitment to diversifying its portfolio and strengthening its premium product offerings despite the slight dip in revenue. In 2018, Altria Group reported revenue of $25.4 billion, marking a slight decline from $25.6 billion in 2017. Though Altria discontinued production of its e-vapor products, such as Mark 10 and Green Smoke, in December 2018. Altria's portfolio diversification was further highlighted by its investments in new ventures into the cannabinoid market with a 45% equity stake in Cronos Group, a deal expected to close in 2019. Additionally, Altria acquired a 35% stake in Juul Labs for $12.8 billion, marking a significant move into the e-vapor market. 2019 revenues $25.1 billion, decreased by $254 million, which is approximately a 1.0%. Key factors impacting revenue: decline in traditional tobacco products. Cigarette sales, led by Philip Morris USA, faced challenges due to declining smoking rates and increased regulatory pressures. Smokeless tobacco product sales under UST LLC and cigar sales under John Middleton Co. were steady but did not significantly offset overall declines. Shift in strategic focus. In late 2018, Altria discontinued the production and distribution of Newmark's e-vapor products, leading to a continued revenue gap in 2019. New growth areas. Helix Innovations LLC acquired Burger Sona Holding, adding on oral nicotine pouches to Altria's portfolio, contributing to the smokeless products segment. Investment in Cronos Group brought exposure to the cannabinoid market, but revenue contributions were modest. The 35% economic interest in Juul Labs introduced Altria to the global e-vapor market, though regulatory scrutiny and market challenges limited the impact. External contributions. Altria's 10.1% ownership in Anheuser-Busch InBev, ABI, continued to provide dividends, serving as an important cash flow source. Shifting consumer preferences towards alternative nicotine products and increasing health concerns further reduced cigarette volumes. 2019 revenue reflects its transition amid challenging industry trends. The acquisition of Helix Innovations marked a step toward diversifying its product base, while dividends from its ABI stake supported stability. However, regulatory and market pressures across its portfolio underscored the need for further adaptation. In 2020, Altria's revenue increased to $26.2 billion, up from $25.1 billion in 2019, marking a growth of approximately 4.2%. This growth can be attributed to several factors. 1. Core cigarette business. Continued strong performance of PM USA in cigarette sales, supported by robust pricing strategies. 2. Oral nicotine pouches. Expansion of the Helix Innovations business, including sales of the on-nicotine pouches acquired from the Burger Group in 2019. This provided a boost to alternative product revenue streams. 3. Smokeless tobacco and wine. UST LLC, through its subsidiaries, saw stable contributions from moist smokeless tobacco products and wine sales under Stay Michelle Wine Estates. 4. COVID-19 impact. Although the pandemic disrupted many industries, tobacco products experienced steady demand as they were deemed essential in most regions, leading to sustained revenue. Overall, Altria's strategic focus on product diversification and premium pricing played a significant role in achieving this moderate revenue growth. 2021, Altria reported revenues of $26 billion, reflecting a slight decline of 0.5%. compared to $26.2 billion in 2020. This decline was primarily due to the strategic sale of Ste. Michelle Wine Estates, completed in October 2021, which impacted total revenue. However, Altria strengthened its nicotine portfolio by acquiring full ownership of Helix, the maker of on! Oral nicotine pouches. This move aligns with Altria's strategy to expand in non-combustible products while maintaining steady performance in its core tobacco categories. In 2022, Altria's revenue declined to $25.1 billion, a drop of 3.8% compared to $26 billion in 2021. This decrease was partly attributed to the continued shift in consumer preferences and the impact of macroeconomic factors on the tobacco industry. Despite the revenue decline, Altria made significant strategic moves during the year. It formed a joint venture with Japan Tobacco Inc. to commercialize heated tobacco stick products in the U.S. under Horizon Innovations LLC, where Altria holds a 75% economic interest. Additionally, Altria completed the wind-down of Philip Morris Capital Corporation's finance asset portfolio, signaling its focus on core business operations. These actions, combined with its ongoing investments in oral nicotine products like Helix and its steady portfolio of equity investments in ABI, Kronos, and Juul, showcase Altria's strategy to balance short-term challenges with long-term growth opportunities. In 2023, Altria's revenue declined to $24.5 billion, a drop of 2.5% compared to $25.1 billion in 2022. This marks the second consecutive year of declining revenue, reflecting the ongoing challenges in the tobacco industry, including changing consumer behaviors and regulatory pressures. A key highlight of 2023 was Altria's strategic acquisition of NJOY Holdings, bringing e-vapor products into its portfolio. This move represents a significant step in diversifying away from traditional tobacco products. Additionally, Altria transferred its Juul equity holdings back to Juul Labs, securing a global license for Juul's heated tobacco intellectual property. These actions align with Altria's strategy to invest in reduced-risk products. Its portfolio remained diversified with investments in Anheuser-Busch InBev SA NV and Kronos Group Inc., although no longer included Juul as of this year. Altria's adaptability in shifting its focus to reduced-risk products and its commitment to innovation are pivotal in positioning itself for long-term growth despite the revenue decline. Looking at Altria's revenue from 2014 to 2023, we see a slight decline, with a compound annual growth rate of -0.16%, indicating that the company's revenue has remained mostly flat, with a small downward trend. Key factors impacting revenue: strong portfolio. Brands like Marlboro continue to dominate the U.S. market, providing stability. Diversification. Altria's investments in alternative nicotine products and e-vapor like NJOY show efforts to adapt to changing consumer preferences. Declining cigarette volumes. The decline in traditional smoking is a significant factor affecting revenue. Strategic shifts. The sale of alcohol-related ventures has reduced income from more stable segments. With a negative compound annual growth rate, Altria doesn't meet the typical positive growth expectation for an investment-grade company. However, this isn't the full picture. We need to dive deeper into Altria's income statement, balance sheet, and cash flow to assess its overall financial health. Next, we'll analyze cost of sales and gross profit margins to evaluate Altria's profitability. If you found this analysis useful, don't forget to like, share, and subscribe for more insights.